Now, speaking of the Fed, Andy, you're writing a piece here on Yahoo Finance about the Fed and their inflation target. We've heard a lot of conversation from Powell and other Fed officials about, we're not sure why, but we continue to miss our inflation target. But as far as you're concerned, it shouldn't be that hard to figure out what's going on here.
It's really stunning to me how the Fed is locked into this orthodoxy that we need to have this 2% inflation bogey hit. And wow, what's the matter with inflation? It's just not coming to that target. And it's mysterious to me that they don't see it. And I'm not an economist. I don't even have a master's degree, never mind a PhD in economics. But it's clear, you ask anyone, I mean, what's going on is technology is making American workers and American companies so much more productive. And that is holding a lid on prices. And so, to my mind, it actually could have serious implications when it comes to the Fed managing the economy, because they're saying, well, the economy is really not that strong. I mean, look at inflation. It's not rearing up. Well, inflation is not going to rear up, not during this productivity boom, this technology boom that we're having right now. And if you could go through industry by industry, you can see it very clearly.
Now, what you note in your piece, though, which concerns me, is that we continue to see education and healthcare costs are rising much faster than 2% there. Also housing, if you look at owner's equivalent rent, rental prices have been up 3-4% a year for the last few. To me, those feel like the three pillars of achieving something like the American dream. So sure, your iPhone does a lot of stuff for you, but you can't go to school and you can't get treated when you're sick. It does feel like we've set ourselves up here for a pretty unworkable kind of political economy sort of situation.
It's interesting. I mean, those sectors that you name, Miles, are the exceptions, and they are huge exceptions. I mean, and what they have in common is, to a large degree or to a certain degree, they don't have technology disrupting them to the extent that the other sectors like apparel, like technology, and like oil and gas, for instance, do, which are being massively disrupted and changed. Education is just, there's only so many Ivy League and elite schools as supply and demand, but that's starting to change with technology, with online courses. And you're starting to see, like, other schools, the price not being held up so well, the price for tuition. Healthcare is its own thing. It's dysfunctional, number one. Number two, people continue wanting more technology because they want to live longer. And housing, it hasn't really been disrupted by technology except with things like Zillow and, online services to find cheaper apartments. And that has had some impact, but not that much. But it's also subject to local factors, like in California, where it's very limited supplies. But, it's an interesting thing, and I just feel like, regardless of your point, which I think is a very valid one, Miles, the Fed is just for some reason so blind to this idea that technology is impacting productivity and inflation in a way they don't measure. They don't measure it right.
And I think it's also worth mentioning, 2% wasn't really the target until 2012. It was stable prices. And the Evans rule put in 2% as the target. So we could have been happy with what we have if they had stuck with stable prices, perhaps.
Yeah, and David Zervos mentioned Stan Druckenmiller, and he's been adamant about this. Like, where did that number come from? It just came, we just invented it one day, and now it's orthodoxy. It's kind of a strange thing.
Well, it seemed like a good idea at the time, because you always wanted to know what they were exactly trying to hit. And you were like, well, just put a number on it and put it out there.
Right.
And now people are asking, there's even people saying, well, why doesn't Jay say, if unemployment goes to 4.2%, then we'll hike rates, or give us more data points, because we're so data dependent. But the problem is, then you're handcuffed by the data.
Right, exactly. And maybe you're measuring things the wrong way or measuring the wrong things. I mean, that's the real risk here, I think, you guys.